Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, July 29th, 2025, we're diving deep into the NZDUSD currency pair, meticulously examining both recent news and its corresponding price action. The New Zealand dollar, often colloquially known as the Kiwi, is notoriously sensitive to global commodity prices, particularly dairy, given New Zealand's standing as the world's largest dairy exporter. Consequently, its exchange rate performance is profoundly tied to Chinese economic data, as China remains New Zealand's dominant trading partner. Recent headlines paint a picture of a broadly strengthening US dollar, directly contributing to NZDUSD's downward trajectory. Analysts from UB Group, for instance, are now suggesting diminishing odds of a significant rally to the 0.6080 level, indicating a shift in market sentiment. Furthermore, a critical report from economies.com highlights that NZDUSD has recently slipped decisively below a key technical support level of 0.5935. This breakthrough fundamentally reinforces the presence of a persistent bearish correctional trend, pushing the pair into new near-term lows. This current market behavior is entirely consistent with the NZD's classification as a risk currency, which inherently tends to depreciate during periods of heightened global market uncertainty, contrasting sharply with the US dollar's enduring appeal as a safe haven asset. Now, let's transition our focus to the comprehensive daily chart, observing the overarching price action from mid-2024 through to the present date. Beginning from a peak near 0.635 in September 2024, the NZDUSD pair has unmistakably been trapped within a well-defined downtrend. This persistent bearish momentum is characterized by a continuous sequence of lower highs and distinctly lower lows, a classic sign of market weakness. Of particular note are the sharp, dramatic plunges witnessed in both November 2024 and again in January 2025, where the price briefly touched extreme lows around 0.50 and even 0.49 respectively. While these were short-lived, flash crash-like events, they unequivocally demonstrate the potential for rapid and severe downside movement when liquidity is thin or panic selling ensues. Disregarding these anomalous extreme wicks, the price has generally maintained its movement within a clear downward sloping channel, underscoring the sustained selling pressure at play. The market has consistently struggled to sustain any significant upward momentum, repeatedly failing to hold ground above the crucial psychological 0.6000 level for any extended duration. Each subsequent attempt to instigate a meaningful rally has been met with formidable resistance, thereby reaffirming the pervasive bearish sentiment that has dominated this pair for many months. Shifting our view to the 1-hour chart, we gain a more granular perspective on the immediate price action, particularly over the past week leading directly into today, July 29th. The chart visibly illustrates a steady and unyielding decline from the 0.6050 area observed just a few days prior, predominantly characterized by a succession of red, bearish candles. This pronounced short-term trend serves to strongly reinforce the overarching bearish outlook identified on the daily chart, plainly revealing a distinct absence of significant buying interest capable of countering the relentless selling pressure. The hourly timeframe is invaluable for providing a granular, real-time understanding of the momentum, clearly indicating that concentrated selling pressure has been a constant feature across various trading sessions. While minor bounces have occurred, none have exhibited the necessary conviction or underlying volume to credibly suggest an imminent reversal of this immediate, entrenched downtrend. Now, let's hone in even closer on the 15-minute chart, focusing specifically on the price action from July 28th and the nascent hours of July 29th, UTC. We can clearly observe a brief period of consolidation in the early part of July 28th, within the tight range of 0.6040 to 0.6030. However, this consolidation was short-lived, quickly followed by a decisive breakdown to lower levels, emphatically confirming the sustained bearish momentum that carried into the market close. The latest recorded close around 0.5969 on July 28 aligns perfectly with the recent news reports of the NZDUSD pair slipping below the critical 0.6000 mark and experiencing significant overall weakening. This very immediate time frame provides strong confirmation that traders are actively engaged in pushing the price down, reacting directly to the pervasive negative sentiment across the broader market. Returning to the expansive daily chart, it's imperative that we precisely identify and delineate the critical support and resistance levels that are most likely to influence and dictate NZDUSD's future price movements. The crucial psychological 0.6000 level has now unequivocally transitioned from what was once a support zone into a formidable, well-established resistance point. Beyond that, prior significant swing highs around 0.6050 and the specific 0.6080 level, prominently mentioned in the recent UB Group's forecast, represent substantial overhead resistance barriers that buyers must contend with. These particular levels were rigorously tested on multiple occasions throughout recent months and consistently held firm, acting as definitive rejection points for any nascent upside attempts, reinforcing their strength. On the flip side, looking at the downside, the 0.5935 level, which various news reports confirm has been breached, now stands as a pivotal retest point for the bears, turning into immediate resistance. A failure to reclaim 0.5935, followed by a sustained retest from below acting as confirmed resistance, would decisively validate further price weakness. Such a scenario could potentially usher in a deeper decline, targeting levels last observed during those aforementioned extreme low wicks, highlighting the fragility of the current price. To underscore the significance of these levels, let's apply a filter to the daily chart to pinpoint crucial historical price action more precisely. If we focus on the period from March 1st to May 31st, 2024, we distinctly observe a critical area where NZDUSD initially found robust support around the 0.5950 zone before staging a notable rally. This historical support now presents a formidable potential battleground, especially considering the recent news confirming the breakdown below 0.5935, making it a critical resistance to overcome for any bullish reversal. Now, let's shift our perspective and examine the period from October 1st, 2024, through January 31st, 2025, a timeframe starkly characterized by extreme volatility and those exceptionally deep, lower wicks. These brief but profound plunges, reaching into the 0.50 and 0.49 regions, provide stark reminders of the significant underlying selling pressure and potential liquidity vacuums that can emerge in this pair. Understanding how the market reacted and consolidated around these historical psychological price points, specifically 0.60 and the mid 0.59s, is absolutely crucial for accurately identifying the valid current trading ranges and potential future price targets. The prevailing market structure across this extended daily time frame predominantly indicates inherent weakness, as evidenced by consistent selling into rallies, which strongly suggests a prevailing preference for short positions among institutional traders. Traders should remain vigilant for any emerging divergences between price action and momentum indicators, as these could potentially signal an impending reversal, although such strong signals are not yet clearly discernible at this moment. So, synthesizing our analysis, what does this current market posture imply for both the short-term and long-term outlook of NZDUSD, and how probable are various scenarios? For the immediate short term, the market bias remains unequivocally and strongly bearish, a direct consequence of the consistent downward pressure and the recent decisive break below the 0.5935 support. There's a high probability, approximately 70% in our assessment, that we will witness further tests of lower support levels. This could entail a move towards the 0.5900 mark or even a revisit to the previous, albeit extreme, lows around 0.585 if the current bearish momentum significantly accelerates. Conversely, a sustained pushback above 0.5935, followed by a successful reclaim of the 0.6000 level, would serve as the initial, albeit tentative, indication of a bullish reversal in the short term. However, based on current price action and news, this bullish scenario appears considerably less likely, perhaps a 30% probability. Transitioning to the long term, the prevailing outlook continues to lean cautiously bearish, simply reinforcing the established trend of consistent lower highs and lower lows that commenced in late 2024. A truly significant long-term bullish reversal would necessitate fundamental shifts, such as sustained dovish remarks from the U.S. Federal Reserve, signaling potential rate cuts or exceptionally strong positive economic surprises emanating from both New Zealand and China. Such a profound, long-term bullish reversal is currently assigned a moderate likelihood, perhaps 40%, as it is heavily contingent on these significant and unforeseen fundamental catalysts materializing. Conversely, a continuation of the established long-term bearish trend, potentially pushing the pair further into the 0.58 to 0.57 range, maintains a higher likelihood of around 60%. This downside continuation would be strongly reinforced by ongoing global risk aversion, continued strength in the US dollar, or disappointing figures from New Zealand's dairy exports and broader Chinese economic indicators. Therefore, keep a vigilant watch on upcoming announcements from the Reserve Bank of New Zealand and the Federal Reserve, as well as the crucial global dairy auction results. These will undoubtedly serve as primary market movers. In conclusion, NZDUSD is presently engaged in a fierce battle around critical support levels, subjected to considerable bearish pressure fundamentally driven by a persistently strong US dollar and cautious global market sentiment. The most important price levels for traders to monitor intently are 0.5935, which now critically functions as immediate resistance, and the crucial psychological 0.6000 level situated above it. On the potential downside, traders should anticipate and carefully observe for further support around 0.5900, with those prior extreme lows, particularly 0.585 and even the significant 0.50 mark, acting as ultimate downside targets should the market experience a true collapse in confidence or liquidity. As always, prioritize robust risk management strategies and meticulously confirm any potential trend changes with the confluence of multiple technical indicators before committing to any trading decisions, short or long. Thank you for joining us today here at Explain the Charts for this comprehensive deep dive into the NZDUSD currency pair. Be sure to subscribe and stay tuned for our next installment of insightful and detailed market analyses.